Hello and welcome to Deal Flow, the show that looks into the intricacies of deal making on the African continent. I'm Erika from Merwe. A hunger for decent portfolio returns amongst investors globally has drawn many to the African continent. The opportunity presented by an emerging consumer and the prospect of catch-up growth can't be ignored. We're looking in this show at the strategy followed by private equity in Africa. What are the deal opportunities? How do valuations compare? And how reasonable are the exit opportunities? But we start off with some of the prominent deals of the week. Kenyan retailer Naivas last week stated that South Africa's Massmart is looking to buy a majority stake in the family-owned supermarket chain. Massmart, owned by the world's biggest retailer Walmart, has said it plans to expand into East Africa's biggest economy. Canadian smartphone maker BlackBerry, struggling to compete in a difficult market, has set up a committee to look at its options, including seeking joint ventures, partnerships or a sale of the company. And US Airways Group and American Airlines are focused on fighting for their $11 billion merger in court. They will argue against the ruling by the US federal government that the merger would reduce competition. Well, Africa is the talk of the global investment community. Here lies the opportunity to boost portfolio returns in a structurally low-growth world. We're looking this week at the strategy followed by private equity investors on the continent. Alexandra Aimé is Managing Director at Emerging Capital Partners, a Pan-African private equity fund. Welcome, Alexandra. Really good to have you here.
Thank you so much for having me.
So we know there's all this talk and hype, and we've mentioned it often on the show about Africa. Now, you've been investing in Africa for many years. Are you seeing the fruit of that hype, or are you still one of the few deal makers on the continent?
Well, we definitely like to think that ECP, Emerging Capital Partners, is definitely one of the leaders in private equity, but without a doubt there is renewed interest. There's a lot of excitement coming into the market. We do see more than $1.4 billion was raised in 2012 for private equity investing in Africa, and that's a significant increase over the last 10 years.
So does that translate through to competition for particular deal flows where in the past it could be sort of very close network relationships as you go in and negotiate a price? Are you now moving to an auction process when it comes to deal making?
Actually, not really. I think you have to distinguish between the South African market and the rest of the African continent. There is a lot of hype about competition, but the reality is in the space or segment in which ECP plays, for example, which is $40 to $60 million per ticket, we don't see competition at all. It's really about the kind of strategy that you're focused on. We are focused on developing a proprietary deal pipeline, and we do that through rigorous and disciplined top-down analysis of sectors and companies. In addition, we have 7 offices on the ground, so we're really able to leverage our on-the-ground network to pursue and identify deals that no one else has seen before. For example, we invested last year in 2012 in Nairobi Java House, which is the leading coffee and casual dining chain in Kenya. This was not a deal that was brought to us by an intermediary. This was a deal that resulted from our own analysis and our own approach to the sponsor.
Alexandra, that message is one that one hears from, in fact, all the Pan-African private equity players. They're really proud of their proprietary ability to source deals. So is that the key to success in private equity on the continent, being on the ground, having local networks, and really understanding what's going on?
Absolutely. Africa is a different animal from other developed market private equity markets, and it's a different animal from South Africa, frankly. In South Africa, if you're focused on top-end deals, if you're looking at multi-billion-dollar deals, there is going to be competition. As you might know, recently, one of the largest South African pharmaceutical companies is being pursued both by an international strategic as well as a local private equity firm. But in the rest of the continent, there aren't intermediaries and there aren't deals of that size. So the key to success is really understanding the differences, the complexities of these different markets. And you can't do that sitting in the US or sitting in London. You've got to be on the ground. And that's really how ECP distinguishes itself. More than 70% of our professionals sit in our African offices, are from 11 different African countries. And so we really are proud of the networks that we have and our ability to source and execute those transactions.
So to be clear, the space in which you're operating then is in the mid-market deal size, because as you said, there aren't many of those big deals.
Well, in Africa, the mid-market is the top market, so it depends on your concept of it. Outside of South Africa, there are very few deals that are multi-billion dollars or several $100 million. We really see where ECP plays, which is 40 to 60 million US dollars, is an ideal area or ideal deal size. We see lots of opportunities there across a variety of sectors and companies and regions, and very little competition.
What do valuations look like? So again, that's a generalization, as you've just said. Many markets, many industries, and it's not homogenous, as we keep hearing.
Well, valuations differ. Ultimately, it really depends on the sector and the region in which you're looking in. I think the opportunity for private equity is because you're not in the public markets and you have a proprietary deal flow, you're able to usually get lower valuations than would ultimately you'd see in the public markets. So it's really about understanding the sector, understanding the value creation plan of the company, and helping the sponsor understand what the value that you're going to be able to bring. In fact, a study was published earlier this year by E&Y and the African Venture Capital Association, which showed that private equity exits achieve almost 2 times that of public markets like the JSE. So both in terms of our entry, we're able to come in at a lower valuation. In terms of our exit, we're able to return a greater value than public market valuation.
So Alexandra, on the issue of exits that you mentioned, is a listing, so an IPO, is that a viable option on the African continent? Because we always hear how some of these markets are rather thin. Would one be getting a better price in the private market to a trade buyer?
Sure, it's a really important question. I think the key is to have a variety of options. So yes, a listing is a viable option. ECP, we have experience exiting both on international exchanges as well as on local African bourses. But the reality is the liquidity on local African exchanges is relatively thin. Therefore, your ideal exit is through a strategic, and we've had a lot of success through that. The E&Y survey that I mentioned earlier also points out that more than half of exits in private equity in Africa is in fact through strategic sales. We've exited to international strategics as well as to local and regional strategics. We only expect that to continue and to increase as the interest in Africa increases.
Now, Alex, I know you've got a joke about private equity and preparing for exit. So as you go into a deal, that's always what you have in mind, because you know in 47 years you have to sell, because that's how private equity works. You have to return capital to your investors. So what is it that you're looking for? Because presumably that goes into your thinking right at the beginning when you select your asset.
Absolutely. It's really important to start that analysis even before you sign the deal with the sponsor or with the company. What we're looking for ultimately is a company with excellent management team that we can work with to execute a strong business plan that has a defensible position and which ultimately can become attractive to the next buyer. We want to build a scalable business that we can then sell to either the public markets or to the private markets. And the way to do that is not through leverage, as exists in America or Europe in terms of developed market PE. Really in Africa, it's about value creation. And so when you go in, you have to have an idea of what is the value creation plan and how are you going to execute that. So for example, Nairobi Java House, we invested last year. So it's been about 12 months. In that time frame, we've established a business plan that shows how we're going to enter beyond Kenya, how we're going to grow regionally. We have helped the company expand by 40%. The sales outlets, we've expanded into 3 other cities outside of Nairobi. That's part of a disciplined value creation plan that we designed before we entered.
What have been some of your failures? So in other words, the lessons that you've learned in your deal making in Africa?
It's an important question, and we wouldn't be investors if we didn't have some knocks as well. I think the key lesson is to always do your due diligence, to be very disciplined. It's very important to know your partners in terms of who are you getting into bed with for this period of time. So it's quite important to do that. I would say that the other lesson is to have multiple options. We have successfully exited 27 different companies in our 13-year history. So we definitely have learned from those opportunities. We've learned that it's important to have multiple paths so that you're not stuck in one. If one door closes, you have an alternative. And that's one of the reasons why we've been successful.
You said to be careful, to be considered about with whom you partner. So not only the entrepreneur, but presumably also the other investors into that asset.
Absolutely. It's important to select and ensure that the group of investors, if you do it in a group environment, have a clear and agreed pathway. So one of the things that does happen in private equity is the sponsor might want to keep the family business. They don't want to IPO. They don't want to sell control. And if you are a minority investor in a portfolio company, you have some restrictions in your ability to direct that. So it's important from the beginning that there's a strong agreement and alignment of interest to ensure that you're able to successfully exit.
Alexandra, what are the challenges of doing business and investing in Africa? Have we moved on from the political risk, the economic risk, the market risk in Africa?
Well, we definitely have. We've been investing in the continent for 14 years now, and our investments, our portfolio companies touch 43 different countries, and you can't do that if you're scared of political risks. However, one has to be disciplined and thoughtful. So if you're entering the DRC, your expectation of the return there is going to be different than if you're doing a deal in South Africa. So it's important to have a risk-adjusted sense of the returns that you're expecting. It is really important. ACP has learned, again, it's all about the partner and it's about the management teams. We spend a lot of time due diligencing both the partners and helping those companies grow through expanding their management teams, supplementing them where necessary in order to achieve that value creation plan that we've designed.
The bigger picture, the kind of regulatory and business support that you're seeing that governments across Africa are offering, what would your conclusion, your assessment be of the quality of that support?
Well, I think in certain regions, for sure, there has been a tremendous amount of encouragement for business and private equity. East Africa, for example, I think Kenya stands out as a country where the environment has been extremely conducive and supportive to private investment. And as a result, East Africa as a destination has grown. So if you look 5 years ago, South Africa got more than 50–60% of total PE investments. Today, that's no longer the case. Investors are following what governments and regulations are changing and encouraging. Those changes in regulations are encouraging investors to look beyond South Africa. They see other places where they can invest successfully, such as in Kenya.
Alexandra, thank you very much for your insights. Good to have you here.
Thank you so much, Erika.
Alexandra Aimé is from Emerging Capital Partners. She's a managing director there. Do stay tuned in Wealth Quest just after the break. Samantha Loring and her guests look at the top 10 rules for investing. Deal Flow will be back next week.